Hello, welcome. My name is Josh Goulding. I'm a founding partner with 4J Wealth Management, and I'm here today to talk to you about equity compensation for executives who are transitioning to retirement. What I've seen all too often is people who have accumulated a huge part of their net worth, which is going to fund their retirement, but it's concentrated in the company that they work for, right? So they may have a $10 million net worth, but the stock might make up 40, 50, 60% of that. And because they work there and they have loyalty to that company, they're very resistant to wanting to sell that stock. And today we're going to talk about all of the things you need to consider as you're getting close to retirement around how to divest that stock, the importance of diversifying it away, and how it can help provide an income stream for you in retirement. So without further ado, let's go ahead and get started. As you know, we work as a team. We're a boutique wealth management firm. There's 5 of us who all work together to help clients meet their goals and needs. We work with about 200 clients, manage about $330 million in assets, and we work every day to try to make sure our clients' goals are fulfilled. There's different types of ways your company can compensate you in the form of stock. There's restricted stock units, there's an employee stock purchase plan, you may have stock in your 401k plan, and then there's your typical stock options, right? Your non-qualified stock options and your incentive stock options. And so we're going to talk about the different types of stock that you can receive, the different taxation, how to handle divesting that stock in a compliant way in terms of making sure you're not doing anything that might be out of compliance with the SEC rules around material non-public information, but just making intelligent decisions around how to make sure your portfolio is set up to optimize you for retirement and not have so much stock or so much of your net worth concentrated in one individual company. Because as we know, it really doesn't matter what company or what stock has done the best over the last 10, 20 years. Virtually all stocks at some point in their history have very, very large declines, and you don't know when those declines are going to happen. Whether it was 2022, where all of the big tech stocks went through anywhere from 35 to 70% drawdowns during the inflation and interest rate craze that occurred in 2022, to going back in time where you saw companies like Foot Locker or Cisco in 2000 reach a peak and then go down dramatically during the dot-com crash. It didn't even get back to where it started for well over a decade. And those are the things that can change your retirement dramatically and just create a scenario where you're not sleeping at night. You're worried about if you have to sell stock at these low points in order to meet your expenses for the month. So this is all about preparing and planning so you don't have to undergo that type of stress. Just kind of equity compensation 101. One of the things you need to be aware of is when your stock vests or gets exercises, it's a liquidity event, right? And so if you sell when it vests, you need to make sure many times that you have the funds available, right, to pay the taxes. With something like RSUs, generally it defaults to where those shares are getting sold to cover those taxes, so you're not hit with a really big surprise tax bill. We also, like we talked about, want to put in place certain risk controls so that you can stagger, right? You can sell your stock at different points in time, at different increments in time, so that it is spaced out and creating liquidity for you over time. And then a lot of executives do opt for taking advantage of something called a 10b5-1 plan, which essentially the best analogy I can say is it puts your selling of your stock in advance on autopilot so that you don't have to think about it. You're not subject to the same blackout rules because you're doing this well before you had any information, and the selling of that stock is automated. And then lastly, we want to be thoughtful whenever you're dealing with stock compensation, executive compensation in the form of equity, being aware of the tax consequences of selling that stock, holding that stock, what happens when that stock vests. So those are all the things we're going to talk about here. I mentioned before the big categories of types of equity compensation are restricted stock units, or RSUs, non-qualified stock options, or NSOs, incentive stock options, or ISOs, which we're going to go a little bit deeper on, employee stock purchase plans, which most employees have the option of taking advantage of, and then some 401ks give you the option to buy your company's stock in the 401k plan. And we're going to talk about at retirement some options you have to take advantage of that from a tax perspective. So big picture, RSUs are probably one of the more straightforward ways you can receive equity compensation. There's a grant date. Okay, that grant date is when those shares are granted to you, and then there's a time period before those shares vest, and that's going to differ depending on the company that you work for. It could be 1 year, could be 3 years. Once those shares vest with an RSU, it becomes an immediate taxable event for whatever the fair market value of those shares are when those shares vest. That's what you got to pay taxes on. And that's why it's so important to be aware, hey, are my RSU shares, a certain number of them when they vest, being sold, so I have the cash liquidity to pay those taxes? And then secondly, depending on what's going on with the company and how much I have in it, do I want to hold all of those shares, or do I want to sell some or all of them even after the tax implications to diversify it into something that is more of a broad investment selection, right? A diversified mutual fund, a diversified ETF, an index fund, something like that. So the tax is automatic, but you do have a choice after it vests to either sell some, or hold for a future date. For non-qualified stock options, that vesting is generally based on a time, right? A certain amount of time passing or a performance milestone. And the tax is triggered when that stock is exercised, okay? The way you pay taxes on and the key is it's non-qualified stock options, which means they don't get any preferential tax treatment. So you're taxed at ordinary income rates on what's called the bargain element. The bargain element is the difference between the strike price and what you exercised it for, right? So if you're given these NSOs with a strike price of some hypothetical stock at $10, and when you exercise it at $60, well, that's a $50 gain that's going to be taxed to you as ordinary income. So do you have to pay cash in order to pay the income tax? You may. If you decide you don't want to sell shares, then you're going to have to fork over that cash come tax time to pay the tax on that bargain element. In addition, you need to pay for the shares at the strike price, right? If it's 100 shares, for example, at $10 a share is a strike price, right? You're going to have to pay that $1,000 out of your pocket if you don't want to sell any shares. Another option is that you do say, no, when this is exercised, I'm going to sell enough shares, right, to cover the cost of buying it at the strike price, and I might sell shares to cover the expected taxes I'm going to owe, and then I'll hold the rest of the shares. Or you may just say, nope, I want to sell it all, cover the taxes, diversify away, and that's fine as well. And we're going to get into some examples. The next stock option most similar to the NSO is the ISO. The ISO is an incentive stock option. It works similarly to the NSO, except there is a potential tax benefit, because at the time that you exercise that stock, that bargain element, if we go back to the same example of the $50, it's worth $50 now, but you can buy it at $10, right? Or $60 at $10, that's a $50 gain. With ISOs, you don't necessarily have to pay that tax at the time that you exercise. What happens is it gets factored into something called your alternative minimum tax calculation, which basically means if you're subject to AMT, then you will have to pay taxes, okay, on that bargain element when you file taxes. But if you're not subject to AMT, even after you exercise, you don't have to pay taxes until you sell that stock, right? And if you wait 2 years from the grant date, or 2 years from the grant date at least, and at least 1 year from your exercise, that gain qualifies as long-term capital gains. So you have a benefit. you have a benefit of, one, you only have to buy in with cash the amount of what the strike price is, so $10. And then if you don't qualify, right, if you don't have the AMT issue, right, and that really isn't a function of your particular circumstances, and speaking with a CPA to make sure that you won't be subject. But if not, right, you can exercise the option but not sell it and not pay any taxes, and then you can delay the sale of that stock until a time that makes sense for you, pay long-term capital gains as long as you meet those requirements, and create liquidity for yourself. So more options with the ISO than the NSO, potentially a much better tax situation, but a little bit more complicated. And then the last two, in terms of stock compensation, is the ESPP, the Employee Stock Purchase Plan, and that's just a way for you to buy the stock of your company at a discount, a 15% discount on a periodic basis through payroll, okay? And that tax is triggered when you sell that stock, okay? That 15% discount, you're always going to pay ordinary income tax. As long as you hold that stock for 1 year from the purchase and 2 years from the grant date, you can actually minimize your taxes. You'll always pay ordinary income tax on the discount, but you can pay long-term capital gains if there is appreciation in that stock. And the last part of equity compensation actually occurs where you own stock in your 401k. And this is a very unique situation where it's called net unrealized appreciation. And the best way I can explain this is with an example. So let's say you have been working for a company for 30 years, you have $2 million in the 401k, but part of what you've been doing is buying stock, your company stock, in that 401k. And let's say you have what you put into the stock in your 401k totals $300,000, and the stock has done really well over your tenure, and it's worth, $1.3 million. Well, now you have $1.3 million of the $2 million in stock, right, in that 401k. If you just roll all of that over, okay, into an IRA, right, and don't do anything else, you don't make any special elections, when you ultimately pull that money out of that IRA, every dollar that comes out is going to be taxed as ordinary income. Whereas, if you take advantage of something called net unrealized appreciation, you take just the stock portion and you move it over into a brokerage account. What happens is the $300,000 basis will be taxed at that time as ordinary income. But all of the other gain, the $1 million of gain in that stock, is outside the 401k, and as long as you wait, right, a year, it will be taxed as long-term capital gains. And as long as you wait, right, if you do the NUA and you move that stock out of the 401k, then the unrealized appreciation has the potential to be taxed at long-term capital gains rates. Remember, if you kept it in the IRA 401k wrapper, it's all going to come out as ordinary income. The catch is you have to move the entire 401k into an IRA except for that stock. So right, in this example, there's 1.3 million of total stock. That goes into a brokerage account. You get the special NUA treatment. The other 700,000 in this example will go into an IRA, and then you can defer that, not take that out until you need it or until you're required to when RMD age hits. So can be very, very valuable, especially when the basis is less than 30% of the fair market value of the stock. I think that's a fairly good rule of thumb to say, hey, NUA could really make sense here, and you want to discuss this with your financial advisor and your CPA, right? Just to make sure you understand, because once you do this, it's irrevocable, but it can make a lot of sense for people who have big time appreciated stock in their 401k. So let's talk a little bit about the NSOs and the ISOs, right? Those stock options that people aren't quite as familiar with, but can become a big portion of your compensation in retirement. So there's the grant date. Kind of the life cycle of this is there's the grant date, and that's the date at which the company gives you the option, right, at some future point in time to buy a certain number of shares at a fixed price. And then you have the vesting date or the vesting schedule, and that says you earn the right to exercise these options over time. And that could be, hey, you can exercise 25% of these options each year over the next 4 years, or it could be some different permutation of that. And then when you exercise the actual option, that is when you are buying the stock at that strike price, even if the stock in the market is trading at a much higher value. In fact, that's the beauty of these stock options, is that you can buy in at 20, even if it's trading at $50 or $100, right? And then beyond that, there's the sale, right? The sale is when you actually decide, after I've exercised and I own this stock, I'm going to sell it, and I'm going to pay the difference between whatever I sold and the exercise price, taxed at capital gains, or if it went down, hopefully not, capital losses, right? You could take a loss against other stocks that you've sold for a gain for that year. So let's go into this a little bit more with the NSOs and the ISOs. So for the NSOs, right, what is the trigger? The trigger is the exercise date, okay? The exercise date is, hey, I've exercised these options, so what happens? There's a taxable event with the NSO. It's you pay ordinary income tax on what's called that bargain element. So if the stock is worth $60 a share and you had a strike price of $20 per share, $40 per share, however many shares you exercise, that goes on your tax return as ordinary income, okay? Beyond that, you decide whether you want to hold those shares, sell those shares, hold some, sell some, right? You have complete control over that. But what's important to remember is if you say, I really love this stock, I want to hold all of it, I don't want to sell any of these shares, you have to pay the taxes out of pocket, and you also have to pay out of pocket whatever the cost is, which is that strike price. So yeah, it's trading at 60, but you still have to buy in for 10, right? You still have to put up the $10 per share times however many shares exercised, right? Now you get all of the shares that are currently trading at $60, and then on top of that, come tax time, you're going to have to pay taxes on the $50 per share gain times number of shares. So a lot of people don't have that type of capital outside, and so what they do is they sell some of those shares at exercise to cover the taxes, to cover the cost to buy it at the strike price, or they just say, no, I want to diversify, I think the stock's at a high, I want to provide, invest in things that provide more of an income stream, and so they just sell it all, that handles the taxes, whatever they net out, they diversify into something else. For the incentive stock option, the trigger for the incentive stock option, right, is also at the exercise date. But because the incentive stock option it's more of a qualified type of tax treatment, it has the potential to be more beneficial. When it's exercised, you're always subject to the AMT, okay, on the bargain element, on the difference between the strike price and the exercise price. But let's just say hypothetically you talk to your CPA and you say, even with this, I don't think your AMT calculated tax is going to be greater than how we calculate it based on just ordinary income, right, through the regular tax calculation. Well, if that's the case, you can exercise, you end up not owing any tax on that right now, and then you can sell the shares later for a long-term capital gain, as long as you've waited 2 years from the grant date and 1 year from exercise, right? So generally the strategy here you want to take advantage of is exercise early in the year, right? And then you want to kind of watch for the AMT, and then also watch what happens with the stock price. If the stock price goes down too much, right, if you're expected to go up and it goes down, you may want to just say, you know what, I'm going to sell this because I was going to get hit with AMT, and now the stock's worth even less, and I have to pay the taxes out of pocket, and just kind of convert it into what is an it basically converts it into an NSO. So the ISO gives you more options, but there's more that goes into it, and it's more of a complex calculation to figure out exactly what you want to do. So for the incentive stock option, it's a little bit confusing, right? But just as a quick summary here, it's similar to the non-qualified stock option, but it has the potential for more favorable tax treatment. When you exercise, there's no ordinary income tax due, but that bargain element, right, that the actual current stock price minus the strike price, what you can buy in at, it does trigger and goes into the calculation of your AMT, alternative minimum tax income. When you sell, okay, as long as it's more than 2 years from the grant date and more than 1 year from the exercise date, the gains can qualify for long-term capital gains. If you don't meet those qualifications, it's called a disqualifying disposition, and it will revert to the treatment of an NSO and be taxed as ordinary income. So the planning tips here are: 1, exercise early so it starts the capital gains clock sooner. If the stock drops, you may want to disqualify, right, sell it to avoid AMT. AMT paid so the other thing is, if you do owe the AMT, it may be okay because you can get a credit, a future tax credit, to offset taxes in future years. That gets a little bit more complex, but something to be aware of. And you need to track your holding periods to make sure, right, especially before retirement or other liquidity events, that you know, okay, this is vesting here, I can exercise this here, I can sell this here, and you know kind of the timeline of events, which, you know, as to when you're going to need this money. You have a timeline of events to know when you're going to need the money based on your particular circumstances. All right, now let's move on to what a lot more people have access to, which is the employee stock purchase plan. Okay, the employee stock purchase plan, you get a 15% discount on the stock when you purchase it, right? That discount is eventually taxed as ordinary income, but it's taxed later. It's not taxed at the purchase time. Okay, to get the best, the best tax rates, long-term capital gains, you need to hold that stock 2 years from the initial offering period and at least 1 year from the purchase. Okay, if you sell sooner than that, it disqualifies that and it just gets taxed as ordinary income. But this is a way of, again, there's a balancing act between when you work for an employer, you believe in the employer's mission, the product, the service, you're getting paid your income from that employer, but when you also have a lot of stock, right, tied to that employer, it creates more risk. It creates potentially more opportunity, but it also creates more risk, because if the stock is plummeting, it's unlikely that your income is going to be going up. You may even be at risk of a layoff. And that's a bad combination. That's so we always want to be mindful of what percentage of my pay is going into the ESPP, what percentage of my investable assets and net worth are concentrated in my employer stock. It's such an important thing that most people just don't think about, because they're like, oh, my company's doing well, I work there, I know the company, of course I'm going to own it. And what that creates is this bias of I am in a safer position than I probably actually am, because I know the company that I'm invested in, right? I mean, that helps, but you know, you can look at so many examples of companies where they're great companies, but the stock goes out of favor for, you know, 1 year, 2 year, 3 year period, and that can have a really devastating impact on your ability to meet your financial goals, to meet your expenses, to sell the stock at a time that makes the most sense to fund expenses, especially when you're getting close to retirement. So what we want to try to avoid is, a lot of times, because these things are on autopilot, is RSUs vest, the company defaults to selling a certain amount of the RSUs to help pay taxes. That's probably a good thing. Not always, but in general, not everyone plans to pay a big out-of-pocket tax payment come April 15th. But then after the company sells the tax withholding, they just hold that stock, right? So that stock builds over time as more and more RSUs vest, and then at some point in time, the individual may look and say, oh my God, I have so much of stock, and they just sell it, right? And so if you sell it all at one point in time, it can have a bunching effect, right, and create a very large tax impact, especially if that stock is doing well. And so you want to be thoughtful about planning out those sales or selling it kind of as the stock vests, or a portion of it, so that you're controlling when that liquidity comes in versus just having it done all at once. Another big thing, a mistake to avoid, is you need to track your in-the-money options that you get, the ISOs and the NSOs, because if you just do nothing and the timeline expires, right, you could just lose the money, right? You're allowed in-the-money options to expire, you never make an election, you just lose that value. Another thing is not understanding, there's certain trading blackout windows where from a certain period of time all the way through earnings, you can't just sell your company stock, right? If you do, you could be in violation of insider trading rules, company compliance policies. So you need to be aware when those blackout windows are, where you can't sell, and then, how do you manage that? One really, I think, good option for many people is a 10b5-1 plan, because that puts a plan in place we're going to talk about where it kind of puts the selling of your stock options on autopilot. A lot of executives do this because then it doesn't really matter what inside information may come into their purview. They already have a plan in place from far before they knew about that of their stock being sold at predetermined increments. So again, for the 10b5-1 compliance primer, there's a 90-day cooling off period. What that means is after you sign the plan, you must wait 3 months before the first trade occurs, right? And that the idea is regulators have confidence that you didn't set the plan up because you heard some tip or were aware of some non-public information. Second big thing is you can't have overlapping plans, right? You can only run one 10b5-1 plan at a time, so it stops you from picking which plan wins after you've seen where the stock price goes. Third, quarterly public disclosure, right? So top executives have to note new plans and completed trades in regular SEC filings, right? So it's with quarterly public disclosure, top executives, right, the C-suite, have to say, hey, here's a new plan, here's the completed trades, and it's in the SEC filing. So it keeps the market informed and it keeps things transparent. You can also do this through RSUs, right? Even shares that vest later can be pre-programmed to sell during blackout periods, lets you turn the vest and sell process into a hands-off, compliant routine, kind of like autopilot, like I mentioned before. So here's an example of how let's say you have Sarah, executive, and she is saying, I'm getting close to retirement. I want to put something on autopilot for my non-qualified stock options to gradually divest. So let's say she has 10,000 vested stock options. She can buy in at 20. That's the strike price. It's currently worth 55, and she's going to retire in 6 months. She signs a 10b5-1 while clear of any material non-public information. She has that 90-day cooling off period where nothing can happen, and then the stock starts to get auto exercised and sold, right, at 1,250 shares per month, okay? Payroll reports that $35 spread, that bargain element, the 55 minus the 20, that's reported as W-2 income in those months, and it bypasses the blackout period for insider trading risk. It bypasses the blackout period for insider trading risk, so you don't have the market timing stress. And then after 8 months, all 10,000 shares are sold and divested for retirement income purposes. So in terms of thinking about this from a timeline perspective, right, you think of it as creating a diversification timeline, creating a kind of a cash flow ladder by staggering your RSU sales with your option sales. You periodically convert equity into cash instead of doing this all at once, or when you're forced to, even worse, in one risky lump sum manner. And then this is a little bit more complex, but some executives will use what are called more sophisticated stock option strategies like collars or forwards to kind of put a baseline, a floor, if you will, on the downside so that they know, hey, I'm not as worried about this going up, I just don't want it to go down, and so they'll pay kind of an insurance premium to protect on the downside. It's another option. If you say, well, I don't want to sell the stock yet, but I'm worried about it going down, options can be used in a protective way to prevent those downside slides. So one of the things that's really important to think about is stress testing. You have an executive who's near retirement and they have, let's say, you run two different scenarios, right? One has 30% of their net worth in their company stock, which still seems really high to me, and another has 70%. And this is not that uncommon, right? So here's how a single stock drop can impact your first 5 years of retirement. So let's take an example of David. David is a 62-year-old chief financial officer of a major corporation planning to retire in 18 months, right? So he can see the light at the end of the tunnel. He's got a total net worth of $8 million, and $5.5 million of that is in the company stock of the company he works for, which is about 68%. And let's say David goes to his financial advisor and says, I want to run a stress test and look at two scenarios. One is I keep my company stock at 70% or 5.6 million, and another where I reduce it to 30% or 2.4 million, and I diversify the difference into a broader pool of securities. So in scenario A, let's assume there's a 1 in 4 chance that there's a drawdown, a material drawdown of over 2.8 million before age 68, which would basically mean that there's a 40% drop in the company. If there's a 40% drop in the company that David works for, his net worth is going to go down by almost $3 million kind of before he really is well into retirement. And I would say that that's enough to dramatically potentially change the trajectory of someone's retirement lifestyle, where they live, how they live, versus a situation where he reduces it, okay, to a much still sizable, but a much smaller percentage of his net worth at around 2.4 million. Now you have that same drawdown, 40%, but now the total amount of the net worth drops by 800,000, all else being equal, and his retirement income plan likely can remain on track, right? So diversifying isn't about timing the top. It's much more about preventing these painful drawdowns or declines in your company stock when you need the steady income most, and you can't just replenish it because you are retired. Okay, so we're going to be finishing up here talking about net unrealized appreciation. It's called NUA, and it's specific to stock, highly appreciated stock within your company 401k plan. What it does is NUA allows you to turn the growth in that stock, that into long-term capital gains, as opposed to having it all taxed as ordinary income. When you do the NUA, the cost basis of the stock comes out and is taxed as ordinary income, right? But you must take a full lump sum to qualify. So let's do this in the form of an example. So let's say you have a 401k, you have a basis in the stock of $200,000 that you've kind of contributed to over time, but the stock's done really well. You've been there a long time, it's done well, and now it's worth $1 million. So you have $800,000 embedded gains in that stock in the 401k. So if you do an NUA, what happens is the $200,000 in the year you do the NUA will be taxed as ordinary income because that is the cost basis of your stock. However, the $800,000 of gain is eligible for long-term capital gains when it is sold. And that's what NUA does. It turns all of that growth into long-term capital gains as opposed to leaving it in that retirement structure, okay? And then when you pull it out, it's taxed as ordinary income, which for many people could be materially higher, okay? Could be materially higher than what capital gains rates be. The key is you have to take out a lump sum to qualify, meaning if you have $1 million in the stock and another $2 million in funds you have in the 401k, that's $3 million total. You would have to do a lump sum distribution where the $2 million goes directly from the 401k to an IRA, and the $1 million in stock goes directly into a brokerage account. And in doing it that way, you have the potential to qualify for NUA treatment. And again, there's a catch here because you still have a lot of money concentrated in that individual stock that if you sell it all at once, if you do NUA, you'll be taxed as long-term capital gains, but that still may create a large tax bill in terms of dollars you have to pay. But if you feel like, one, the $1 million in company stock relative to your overall net worth doesn't make you nervous, and you have the potential in retirement, after you retire but before social comes in, before required minimum distributions start, that you can actually gradually sell the stock, incur long-term capital gains, but at a 15% rate, and then gradually diversify, it can actually make a ton of sense. So it really just depends on your individual circumstance, but really important to know that this is an option for you. A lot of people are unaware of this. Other things you may not be aware of is if you're an executive, a lot of times you're retiring before your 65 or 67 timeline. Not always, but many times. So keep in mind, that you are allowed, okay, to take penalty-free 401k distributions. You still pay income tax, but you avoid the 10% penalty if you retire from your employer, from the employer that you're currently at, and not or, but and you're already 55 or older. Secondly, if you're not yet 59 and a half and you want to take money from your IRAs because you don't have money outside, there is a way to do that. It's complex. You definitely should talk to your CPA, but it is possible, and it's through structured IRA withdrawals called Rule 72T. So both of these strategies allow you to withdraw money from retirement accounts while avoiding the 10% penalty, even though you're under 59 and a half. So if we're starting to kind of take all this together, the RSUs, the stock options, Roth IRAs that you may have, IRAs you have, eventual Social Security, I think a good way to think about this is in the first 1 to 5 years of retirement, you want to try to diversify away some of that concentration risk in your employer stock, right? And so that means, gradually divesting of the RSUs, selling the options on a periodic basis, and kind of using those liquidation events as funding retirement for those first 1 to 5 years. It might be 1 to 3 years, it could be 1 to 7 years. It depends on how much you have, but that idea. And then years 6 through 10, your income might be a little bit lower. You're looking at possibly doing Roth conversions. You're taking some withdrawals from your IRA or 401k in order to kind of live the life you want to live. You're managing your tax bracket as best you can by doing the Roth conversions and not taking too much out of the IRAs. And then really 10 plus years, 70 and on, you're getting Social Security. You're having to take required minimum distributions. And so you're more on autopilot, I would say, at that point, because there's only so much you can do to control your taxes once you're having to take those RMDs and Social Security is coming in. But I think this is a good framework to think about how can I ladder my cash flow in the first 1 to 10 plus years of retirement. If you are charitably inclined, when you have low basis stock, right, whether it's RSUs or ISOs or NSOs, right? Any of these stocks you hold where you have a low basis, high gain, it can be very effective to donate those low basis shares to a charity, especially in high income years or big RSU years, because it will help to reduce your tax burden. The donor advised fund allows you to separate the tax deduction that you get, which occurs in the year you make the donation to the donor advised fund, from when the charities actually get the money. So you could put $100,000 into a donor advised fund, benefit from the tax break that gets you, but then over the next 5 years, you send it to charities of your choosing, maybe it's $20,000 a year. And you avoid the capital gain on the stock by gifting the stock directly, and you get the benefit of a tax deduction of the fair market value of that stock, subject to your particular tax circumstances based on other income that you have. So if you're already charitably inclined, this is something definitely be aware of if you had a lot of concentrated stock, low basis stock. It generally is a much better way to contribute to charities than just to give cash directly. So kind of as you're getting close to retirement, I think it's really important to have a spreadsheet or some sort of a table that keeps an inventory of all of the grants you've received, what your cost basis is, the different type of award that it is, whether it's an RSU, an NSO, an ISO, if it's ESPP. I would separately track stock that you have in the 401k plan. And then for each of the grants, what is the grant date? What's the vesting schedule? How many shares? What's the exercise or strike price? What's the current market value? What are the tax implications? And that way you can, one, make sure you don't miss any options that you should have exercised and didn't. And two, it can start to build a framework for what your cash flow is going to be, especially in those first 5-7 years of retirement, when you're going to liquidate, and then how much is going to be there, where you're going to owe taxes, and the net that's left over to pay bills for that year. Right? If you marry this with a charitable giving strategy, it makes it even better, right? So this is complex stuff. There's a lot of different types of these equity awards, and frankly, I've seen equity awards that are even more complicated than what we're looking at here. So it can definitely get more nuanced, but it's really, really important to understand how this works as it relates to your particular compensation. And I would say, especially if you're an executive and you're getting closer to retirement, you need to be mindful of this. You need to be aware of it. You need to keep track of it. Thank you so much for attending. I hope that this didn't put you to sleep and you found it of interest. You can find us at 4jwealth.com. You can email us at josh@4jwealth or info@4jwealth.com. We would be more than happy to hear from you, answer questions that you may have. But the goal here is that you're getting some good information, some things to think about. And if you want guidance along the way, we're here every step.